Good morning, everyone. After this Super Bowl that was not really that good a game, kind of a blowout. I think it was 24-0 at the half, at which point I turned and watched the end of a movie I was finishing, and I checked my phone and I saw it was up to 34-0, and I was like, okay, I don't need to go back and watch those $5 million commercials anymore over and over and over again. But today's topic, we're going to talk about how the stock market reacts with different Super Bowl winners. I don't know. You always hear about it, so we're going to talk about it, and then also going to talk about the first ego stock that I'm going to release. I mean, we're already investing, but I'm going to release one to talk about, and then Corey's going to talk about McDonald's. There's another company that has its finger on the pulse of the American consumer, not for healthy reasons, but for eating reasons, for cheap eating reasons. So before we get started, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions are expressed are mine and Corey's alone. So a very sad Super Bowl in that the Bengals were not in it. I know Steve would say the Raiders are not in it. Corey, I don't even know what's your favorite team. Dallas, what?
I'm just college.
He's just college, so he didn't care. So the rest of us, we do care a little bit. Um, I guess I was happy that the Chiefs didn't win a third time in a row, and that the Eagles, who did win, they won a few years ago, not too long ago, that they got another chance there. And I'm going to reach out to all my Eagles friends and congratulate them. But what do we care about? At least on this call, we care about what's going on in the stock market. And, they analyze everything. I pulled this. This was from last year. It'll be updated here in another week for this year. But the Super Bowl indicator. So good news. The S&P does better when the NFC wins. So if you were going to root for a team, if you're like Corey and you didn't care, you want the NFC to win. So they did. The average up year when the NFC wins is 10%. When the AFC wins, it's 8.1%. I don't know if that's statistically significant of a difference. The good news is the market goes up on average anyways. So you can see some of the stats, but lately, the AFC had been pretty good. So, you look at Kansas City and New England, look at those up years. Wow. You'd say the last 5 years the AFC won, it averaged over 20%. So, I don't know. Part of me was thinking, Kansas City people, middle of the country, Philadelphia people near New York City where Wall Street is, maybe they're more excited, happy, ready to buy stocks and run the prices up. That's going to play out that way, but, at least I can hope. Another stat, and this worked out good for us. I'm looking at this retroactively. The stock market does best when it's a blowout win. So I think the final score was 40-22. So blowout wins, double digit, 10.9%. If the Eagles could have held on for a 21-point win, 13.6%. And now here's the bad side. Sorry, Philadelphia. Sorry, my friends in Philadelphia. When Philadelphia wins a World Series or a Super Bowl, bad things happen. So, I don't know that we want to count too much on this, but just recently, 2008 great financial crisis, the Phillies had won the World Series. And then Eagles win the Super Bowl in 2018, and that was the worst year since 2008. So, we're getting all kinds of indications because this means absolutely nothing. It's just fun to look at. So, we're just going to hope the market does what it normally does and goes up. So, Corey, what do you think about any of that?
I mean, the Eagles, compared to some of the other things on that list, the Eagles one wasn't too bad. 2018 was 2018 was kind of nasty at the end, but not like the others.
So, but you can understand that mathematically, none of this means anything. It's just fun to look at. And this is what statistics can do. They can prove or disprove anything depending on how you use them. So,
Yep. I would not change course. I would not be going and placing trades based on Philadelphia winning the Super Bowl. No.
But maybe the people of Philadelphia are. Okay, so
Maybe they are. Maybe they have to liquidate stuff to pay for their parties that they had. I don't know.
or maybe they bet on the Eagles and they got so much cash coming in that they're ready
You're
to
right.
invest it now rather than gamble it.
You're
Maybe.
right.
Who knows? So one of the things that we do every year, every year since last year, so we have 2 years in a row, is we have our ego stocks exponential growth opportunity. So pick 10 stocks. We don't necessarily stay in them all year. We can rotate in and out. But we're picking aggressive stocks that we believe have the capability to double or triple. Last year, out of the 10, we did have 2 that doubled, Toast and Palantir. But when you pick aggressive stocks, guess what? They don't necessarily double. They don't even necessarily go up. So, there are stocks that we had that went down 30 or 40%. So this is really only in the aggressive investing in our highest aggressive ratings. But the first one I want to talk about today that we are entering in, and some of these transactions started to happen last week, is Natera. I saw this stock last year, and boy, I wish I would have went in when you see the graph, but I really like this company. So many of you know that we have a heavy tech investment, and tech has done great, will continue to do great, but it's good to diversify a little bit. Now, Natera does different testing, oncology testing, prenatal testing. I consider it technical, but it's just certainly more in the medical side, to identify things that could go wrong, drive in, and it's kind of like that. What do you call it? Non-invasive testing. That people like me say, boy, I really want to do this, but it's going to cost me out of my own pocket because my insurance company usually doesn't cover this kind of thing. And you hope the answer is zero, like, oh, I really didn't need to do it. My health was fine. There was nothing that was flagged. But of course, and then you say, well, I spent whatever, 500,000, whatever it cost. There's different levels of cost. But, I spent the money, I wasted it. It's kind of like, oh, but I didn't find anything out. But the case that when you do find something out, and this is what really intrigued me last year as I was looking at this company, is there was an article in the Wall Street Journal where a person said, hey, I want to say it was a guy in his 40s, and it's prior to you would normally get your colon cancer testing, things like that. He went ahead and did this, and it flagged something. And I want to say he was like 44, but it flagged something. And so he went and got the follow up, and he found that he had whatever level 2. I think it was the same cancer that Steve Jobs had. I can't remember which one that is, but it's when you get it, you usually don't find it till you're like, stage 4 in your terminal. But this guy used this Natera testing. He found out he was stage 2, which is one of the earliest times you'd find it. He showed no signs of it. Like, as far as no signs, he wasn't feeling sick or showing anything. It just picked it up on this test. And his doctor, basically, they worked, even at stage 2, I want to say it was only a 50% survival rate, but he survived. So it's a testimonial. So this is the kind of company that, like, I want to invest in, because it really is a good thing to identify these early, that you can address. And you can check out the website. It's Natera.com. That's what I'm looking at right now. One thing that I always look at is, hey, does insurance cover it? Yes, they do have insurance that covers it. It depends obviously on the plan. If you're in these insurance companies, obviously check before you go, schedule your test, because it depends on the level and the need and things like that. So it's funded both by consumers and insurance companies, and it has a positive benefit. Now, what I'm going to show you is here's the stock, 1-year chart. So of course, I wish I invested it in last year. I think I read the article in April or May, and like, oh, I missed out on that. But something is this company even more valuable? It's a $22 billion company. It has plenty of room to grow. Guess what? People are getting older in the United States, and the more they do these tests, you get that scale effect where the company obviously will make money, but it'll be less expensive to do them. The more technology advances, the information that comes out of the test will show things. They can use AI to figure out, hey, this indicator shows this, or this indicator shows this. So this is one of our ego stocks. Natera will be following it. And then tomorrow I'll hit the second one. We have 10 of them. So I'll try to hit one each day and get you through it. So now I want to turn over to, hey, this is testing for health. Here's the company.
We can test your health.
You can test your health at McDonald's, because if you can eat a lot of McDonald's and stay healthy, you are incredible. My kids eat way too much McDonald's, but
I think there's somebody pretty high up in the government is pretty famous for eating some McDonald's.
Oh yeah. Oh, I thought he ate KFC. I don't remember, but I did my time. I worked at McDonald's. I did my 3 or 4 months when I got back from basic training before I started college. Corey, did you do a stint at McDonald's?
Yeah, not working. I worked at Walmart.
Oh,
Yeah.
I was wondering if you actually worked there, because
We had a McDonald's in the Walmart though, and I was
Oh.
cool with everybody in there. We'd go in and kind of shake hands, stay in touch with everybody in the McDonald's.
I always think of McDonald's as the place where a kid gets their first job. I mean, I think they start hiring at 14. Their whole process is built on repeatability. It's, McDonald's is the same no matter where you go, it seems like to me. But you can take a 14-year-old, and when my kids, went for these jobs, and I've had a few of them that worked at McDonald's, and it's like, they'd be like, Dad, what are they going to ask me in the interview? And I said, they just want to know that you're going to show up on time and you're going to listen and learn. They expect you to know nothing. So go ahead. Tell us what McDonald's did on their earnings today and what's going on with them.
So definitely I've never worked at McDonald's, but spent some time there, if you know what I mean. So going to their earnings report, which that's kind of the first place I like to go when a company announces earnings. You can see global comparable sales 0.4%. This is obviously a mature company. If they had double-digit earnings growth or double-digit, revenue growth or revenue decrease, you'd be really shaking your head. It's such a mature company. But the US decreased 1.4%. Probably nothing really. International market segment increased 0.1%. Okay. International developed licensed markets increased 4.1%. That's pretty good. I will say with McDonald's, and I'm going to come back to the earnings report, there is a little bit of headline risk when a company announces earnings. So you maybe don't want to just look at the headline. If you just looked at the headline, McDonald's revenue disappoints as U.S. customer spends less. Was that true? I guess, but it's really a pretty sleepy company. The stock is up 5% today. The stock is at an all-time high. Well, it's a couple percent from an all-time high, which it hit just a few months ago. You can see it's just kind of a sleepy stock, just sort of up and to the right. You're going to get some little dips, but revenue we saw hadn't grown a ton this past year, really not at all, company-wide, and the stock really hasn't grown much. So again, they're buying back shares. It's kind of just a sleepy company. I do want to say this though, just in case, not that anybody's out there looking to buy McDonald's stock, other than maybe those dividend growth investors, which they did. Where is it? They did announce a 6% increase on their dividend. So that's great. But coming down to the balance sheet, you can see that, okay, the shares outstanding decreased a little over 1%. They're buying back shares, they're increasing the dividend. It's just kind of a sleepy company. Also, you can look at this revenue, and this is just in the quarter. Some people think McDonald's, I don't really like the food. And it's like, yeah, well, some of the McDonald's owners don't. It's really a little bit more of a real estate company than a food company anyway. It's sort of a
Hmm.
publicly traded REIT in a way. They're getting a heavy majority of their revenue just from franchise fees. So
Interesting.
they do operate some stores, and then Mike, I don't know if you've ever seen this, but there's a company that if you did just want to own the restaurants, you could buy yourself some Arcos Dorados holdings. So it's the master franchise of the fast food restaurant chain. Have you ever studied them, Mike?
No, I have not.
Okay, so 20 countries, 2,400 restaurants. It is the largest. So, I mean, that's kind of cool. McDonald's is so big that they have a franchisee that's a multi-billion-dollar company, um, publicly traded. And this is, hey, I just want to own the restaurants. I don't like real estate. That would be, a little bit more of an Arcos play. That stock, you know,
Not done well.
hasn't been great. But if that's your thing. And then
Eh,
I was reading through Arco's recent earnings report, and they've got,
mhm.
billion plus in revenue a quarter. It's an interesting company. It trades at a very, very low valuation. I don't even know how many people study the thing really, but
No.
that's a little bit in the McDonald's world that I'm aware of. So
I will say too, after, taking business classes and, I get it. McDonald's food, maybe you're just like, it's bland. It's kind of like, I mean, there's, what do they used to, I used to have some kind of pork rib sandwich that I liked. I don't know. They don't even sell salads there anymore that I know of.
my kids
Um,
like the fries though, the
Yeah, the
fries.
kids and the fries, and I'll tell you, their app is very easy to use. I have their app. You'd think I was a frequent McDonald's customer by if you look at my app usage, because my kids will all the time be like, "Hey, Dad, get me a large drink and a large fry." And if you have the app, and I'm telling you, get the app, you can get a free large fry. You buy a large drink, get a large fry. So it's like $1.85 on my credit card. Boom, I hit it. I say, here's the code. They go through the McDonald's drive-through. They get a large drink, large fry. That's a pretty good deal for $1.85. I know McDonald's wants you to draw you in to buy more than that. Doesn't work on us. But it just, I kind of like think of great American companies, and this is a great American company. I mean, if you study the history of McDonald's, the McDonald brothers, and then the Crocs bought it, and how it's grew to one of the largest food companies in the world. I mean, you go to another country and, it could be third world country, and then all of a sudden on a corner you'll see a McDonald's, and you can go in there as an American and be like, I know what I'm going to get. I'm going to get the same kind of quality. I'm going to get this food I'm used to.
Same
Um,
experience.
yeah, so I mean, I appreciate that. Now, of course, when my kids were little and they wanted to buy all those little dumb toys, and and I had to go to McDonald's because there was I don't even remember what they were, Pet Rocks, or I don't even know. And I was like, are you serious? We're going to McDonald's just because you want this dumb little toy? That's
They
good
partnered with
marketing. That's
Pokemon,
Pokemon. Yeah, there you
right
go.
now. And so you can get a pack of cards with a Happy Meal. It's hot right now.
And who can't forget remember the Monopoly game pieces? I actually
Oh
like
my
that part of
goodness.
it.
Wasn't there fraud with that? There was
Yeah,
like a documentary.
there's a great documentary on the fraud of the Monopoly. It was not McDonald's fault,
It
but
wasn't that Beanie Babies. They had the Beanie Babies.
Beanie Babies, yes. Oh my gosh.
At
Well,
one point, I think McDonald's was the biggest toy company in the world too, because of all that. So, that's the thing. It's a quality, like Mike said, it's quality American company, kind of a sleepy company. The stock's up 5%, so hey, we'll take that. But that's good. That's good for the market.
yeah,
But it's not one that you're gonna blow your socks off. I don't know.
there's
Who
there
knows? Maybe they'll get into AI.
yeah, that's what they need, an AI initiative. I
Maybe
mean,
they'll
there's
give you an NVIDIA chip with your Happy Meals. A mini one, a mini one.
actually maybe they'll get into digital assets, and they'll give you a McDonald's coin that'll be worth something like Bitcoin. Um, and I just have to believe there's landfills filled with Beanie Babies someday because of McDonald's, probably. But anyways, That's all we got today. We'll be back tomorrow. Have a good one. Bye.